Welcome to the Apprentice Trading Library. This segment will explore the 3-day rule. The 3-day rule states that an investor should wait 3 full trading days after a major news event where price dramatically changes to decide whether to buy or short an asset. We'll explore the multiple reasons why this helps investors avoid losing money and helps them make money. After a major news story or event hits and the price of the underlying asset spikes dramatically higher or lower, investors often are filled with emotion. Emotion makes us act irrationally, often buying the asset at highs, out of greed, or selling the asset at lows, out of fear. After a price spike on amazing news, investors are often filled with FOMO, fear of missing out, and will chase. Historically, stocks, crypto, commodities, and other assets top with euphoria after amazing news. This is because the market already anticipated the news event and prices run sharply higher going into the news. Once the news is available to the public, the euphoria triggers the last buyers to jump in. This creates a void of buyers, everyone is already in. Then big money out will sell into the euphoric buying of retail investors. With a lack of buyers, price will usually fall sharply. Some good examples of this in crypto was the Bitcoin spot ETF approval in January 2024, where price corrected 20% from the run-up on hype and spike on the news, and the 2021 Bitcoin 69,000 high on the run-up and pop on the futures ETF approval, followed by the collapse to 15,000. In commodities, oil ran $62 to $105 in 3 months, leading up to the Russian invasion of Ukraine in 2021. It then popped to $130 on the news. The news was the top, and oil was trading back down below $70 per barrel within 1 year. When looking at stocks, a common occurrence will be a sell the news on big earnings, where price has increased dramatically over the previous quarter. In other words, investors were anticipating the fantastic earnings, buying the stock, and pushing price to an extreme. Once the news hits, the last retail buyers will FOMO in and big money will begin dumping. Valuations at the highs are often stretched, and smart money begins to calculate the odds that profit and revenue growth is as good as it gets. Investing is a psychological game of follow the leader or hot potato. Everyone wants in until the music stops, then whoever is still in is left holding the bag. Having a contrarian view of markets and assets at extremes is usually the safest for one's portfolio. On the asset collapse side, fear is the most powerful emotion. A great example of this in crypto was the FTX fraud news hitting in November of 2022. While it seemed like catastrophic news to the crypto markets, Bitcoin actually bottomed at that time in the $15,000 range. In the following year, it rose over 100%. Waiting 3 days after that news to reevaluate helped investors avoid the emotional fear and panic, either holding their Bitcoin or even evaluating the fundamentals to buy Bitcoin. The stock market at the COVID lows of March 2020 was another great example of fear escalating to panic. While many dumped their stock positions at the lows, waiting 3 days to reevaluate could have saved many from this fate. It turned out to be one of the best buying opportunities in recent history. The S&P rallied over 150% off those lows in the following 18 months. The 3-day rule also works because of fundamental factors. When a stock collapses on bad news, it is wise to wait the 3 days because there is likely continued selling due to margin calls, forced selling, upgrades and downgrades, and funds buying or selling for various reasons. A margin call occurs when an investor is using leverage in their stock account and takes a big loss on a position. They often are forced to sell a certain amount of stock to cover the margin call. This can continue to put downward pressure on a stock for 3 days, which is the time a broker gives an investor to come up with additional funds or to sell some of the underlying stock. Often after a big drop, analysts will downgrade a stock. Likewise, when a stock has a monster move to the upside, analysts will often chase, just like investors, and upgrade a stock. The downgrades can cause selling pressure, just like the upgrades can cause buying pressure, as investors with FOMO move into the position at highs. Giving it 3 days allows for the volatility and whipsaw to quiet down, giving a better perspective on the true direction of the stock. Funds buy and sell stock, commodities, and crypto for various reasons. However, just like investors, there are criteria they follow. Sometimes, when an asset dumps, institutions may decide the asset no longer meets the criteria for their fund and dump it, regardless of price. This can put additional pressure on the underlying asset. In the same manner, when an asset surges, it can come on the radar of institutions. Some institutions may decide to add it to their portfolio as a long-term investment, even if it is too expensive. This can put continued upside pressure on the asset for a short period of time. A good example of this would be a stock being added to the S&P 500. Funds that track the S&P 500 must buy that stock regardless of its valuation. In summary, there are multiple reasons the 3-day rule is wise to follow and beneficial to investors. The first is investor psychology, avoiding panic selling at a low or panic buying at the high. Give yourself 3 days to calm down and make the right decision. The second is fundamental. Whether it is continued margin call, forced selling on an asset at the lows, analyst upgrades or downgrades due to major price movement in the underlying asset or fund accumulating or dumping, 3 days is the ideal amount of time to wait to avoid being caught on the wrong side of the trade or entering or exiting at a bad price. Thank you for watching the Apprentice Trading Library. Please visit verifiedinvesting.com for more.